Welcome to the 3-Edge Week in Review for the week of September 15th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss the role of the U.S. Federal Reserve, which reduced short-term interest rates for the first time this past week, and we'll examine why the Fed is currently playing such an outsized role in both the news headlines and the financial markets. So let's get started. The Federal Reserve's Federal Open Market Committee lowered short-term interest rates this past week in response to what appears to be a potentially material slowdown in the labor market. And the move also comes amidst unprecedented pressure from the White House for the central bank to lower interest rates. Fed Chair Jay Powell made it clear in the press conference following the FOMC meeting that with inflation still above the Fed's 2% target, the Fed will face difficult trade-offs in the coming months as it considers whether to make further cuts in subsequent meetings. During his press conference, Powell stated that both employment and inflation are heading in the wrong direction at the same time, and so in Powell's words, we're stuck between our two mandates. So Steve, with the Fed gaining a great deal of attention recently, perhaps you could level set for us and just provide a brief overview of the U.S. Federal Reserve, why it was created, and what it's charged to do.
I think that would be good, Fritz. The Federal Reserve Board was created by Congress, an act of Congress in 1913. It was a direct response to the panic of 1907. And back in 1907, there was an investment trust company called the Knickerbocker Trust Company, and it went bust. And it was such a big deal that there was a run on the banks, there was a run on other investment trusts. Stock market fell nearly 50%, bonds plunged, interest rates soared, there were many bankruptcies, and even the New York Stock Exchange lost their liquidity. It was a real catastrophe. And J.P. Morgan got all his friends who were heads of all the major banks, put them all in a room in New York and said, no one's leaving this room until we all agree to pledge enough capital to get the stock market back on its feet and get the economy going again. And that's what happened. They were the lender of last resort. Everything recovered. And a few years later, Congress said, look, we can't depend on a J.P. Morgan coming along to do the good deed. We have to have an organization that's set up to do that. So the Federal Reserve Board, otherwise known as the Fed, was set up to be the lender of last resort, to be quietly in the background. But if there was ever a major panic or disaster, they would come in and be the lender of last resort. Well, since the crash of 1987, the Fed has been more and more intervening in the workings of the markets in the economy. And because of that, they've been using more stimulus every time there's a problem. And some of that stimulus has been caused for why the tech stock bubble got so big before it burst, and why the housing bubble got so big before there was a housing crisis. And after COVID, the Fed ended up printing more money and increasing its balance sheet in 3 years than the previous 108 years going back to its inception. So the Fed has gone from the lender of last resort to a very active participant in the economy and the markets. And now the markets, quite frankly, seem to be addicted to Fed stimulus. So they do have a dual mandate, as you mentioned, and this is from Congress. And Congress has given them the mandate to both support full employment and to keep prices and inflation stable. And sometimes it's hard to do both. And as you mentioned, Chair Powell mentioned in his meeting that right now they're leaning towards supporting employment. They're worried about employment weakening, but they're afraid that inflation is still sticky and rising, so it's going to be difficult. So Fritz, I wanted to ask you, we had a great discussion right after the Fed announcement, and I thought you had some great thoughts about the Fed's dot plots and all these new concerns about the Fed losing their independence.
Sure. So the dot plot it's basically a report. It's called the Fed's Summary Economic Projections, and it's literally a chart of dots that represent each member of the FOMC's projections for the future path of interest rates. And the dot plot is intended to provide transparency into, all the different views within the committee regarding the future direction of monetary policy. And interestingly, this past week, the dot plot was really interesting because first it showed a wide dispersion among the FOMC members about where they saw the future of reduction in interest rates. And in particular, this past week, the projection for future rates cuts was impacted by one outlier. And that outlier was a newly appointed FOMC member, Scott Mirren, who was just nominated by President Trump and is a staunch ally of the president. And Mirren cast a dissenting vote saying that he was in favor of a 50 basis point cut in interest rates rather than the 25 basis point cuts the FOMC approved. And Mirren also believes that short-term interest rates should be 1.25% lower by the end of the year. And after the meeting, one reporter wrote that Mirren's dot on the dot plot looks like the kid on the playground that the other children refused to play with. And when Powell was asked about Mirren's vote, he replied that one vote cannot control a committee with 12 voting members. And so this all ties back into investor concerns over the independence of the Fed in a way that really we've never experienced before, which is what our discussion was about. And the concern is that the president is seeking to exert influence over the Fed, and in this case, getting them to lower rates faster and further. And as we know, the president has also attempted to remove another Fed governor, Lisa Cook, but this move has been blocked by the courts. And it's just important to remember, the Fed was established, as you said, to be independent of politics. I have one last interesting point about this from last week's meeting, and that is that the other two Trump appointees who were dissenting votes at the last meeting, they voted for the 25 basis point cut at this meeting, along with the rest of the members. So perhaps this was their way of sending a message in support of Fed independence. So it was just a very interesting meeting, and we'll have to see what happens going forward. But my question for you now is, with the independence of the Fed potentially in doubt, and given that there's a lot of uncertainty about, how much interest rates will be reduced, how quickly, what is an investor supposed to do in such an uncertain situation? I mean, this is highly uncertain. So how do you take that into account if you're an investor when you're trying to make investment decisions?
Well, it's clear that the Fed has made a move more in favor of stimulus to support employment and the economy rather than to continue its fight against inflation. And sometimes when that happens, especially during a stock market rally or bubble like we're having now, that could further add further liquidity into the equity market. And sometimes when you have a stock market bubble and you get extra liquidity, you get what's called a market melt-up, which is the most spectacular part of the rise of the rally. It happens right near the end. It's kind of a climactic buying melt-up. And this is not completely out of the question. So we have to consider that as a possibility. Secondly, though, the bond market has a totally different view about what happened. The bond market is worried that the Fed is taking their eye off the ball fighting inflation. Instead of longer-term interest rates going down along with the Fed rate cut, the long-term interest rates actually went up afterwards. Yeah. In other words, the bond market investors are saying, hey, wait a minute, we counted on you to fight inflation. Maybe you're taking your eye off the ball on fighting inflation. And a lot of people have a naive notion that if the Fed cuts rates, mortgage rates will automatically come down. And the naive notion is that mortgage rates are not tied to the Fed rate. Mortgage rates are tied to intermediate and longer-term bond rates, and they started to go back up. So that's another factor. So if you put this all together, I would say with the possibility of a market melt-up, we would keep our equity allocations, which are quite on the high end right now, intact, but with a short leash, knowing that we need to watch the early warning signs since this bubble is already so inflated. Also, the whole prospect of stagflation has not gone away. The idea that the employment market is softening, the economy is starting to show signs of softening. Inflation is showing signs of not only being sticky, but maybe starting to go back up again, rebound again. And so we strongly advocate that alongside equity portfolio allocations, there should be an allocation to hard assets, which is the proven hedge against stagflation. And if I go back to the early 1970s, Wall Street gave a very low probability of stagflation, that you could have both a weakening economy and higher inflation. And that was proven so wrong. And we had the worst stagflation in U.S. history in the 1970s. So it's not out of the question that it could happen again. So alongside our equities, we advocate some hedge against stagflation, and that's hard assets.
Excellent. Thank you, Steve. Thank you. It certainly seems as though, like it or not, the Fed will be in the news for the foreseeable future. So that will do it for Steve and me for this week. We'll be back next week with another edition of the 3 Edge Week in Review. And all our videos are always available on our 3 Edge YouTube channel. If you know someone who you think might benefit from our videos, please feel free to share them. And in addition, if you enjoy our videos, please consider subscribing to our 3 Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.